some interesting developments. You know, the three macro assets, commodities that are really pushing equities, rates, I think, are the big one. And what I find very intriguing about rates is, you know, if you look at what's coming out around inflation data, I mean, we just got the Philly Fed data came out today, and it was showing a continuation of inflation trends have peaked, you know, a continuation of that trend. Housing data continues to suggest that. Even the Federal Reserve's tone is getting less hawkish, you know. So, and at the same time, we're hearing the ECB talk about getting aggressive with inflation, and all these things, you know, should suggest, you know, inflation is easing in the U.S. We should see the dollar continue to go down, and we should see rates continue to go down as bond investors buy bonds with great yields as we go into a slowing growth global economy. But that's not what we're seeing. We're seeing the bond market's just simply not buying what's going on right now just yet. So we, you know, if we would have broken out above this is long dated bonds, you know, if we would have broken above that 123 directly, then that's the bond market saying they believe the Fed inflation is probably coming to an end, and now we got to contend with slowing growth, which would definitely, you know, put a bid under equities based off how extreme rates have gone in this move down. But we're not seeing that yet. We're not seeing the buyers step in to rates, and so that's a little concerning. The two paths that I see playing out, I've talked about this quite a bit, is that we just completed a fourth wave, and we have a fifth wave down to like the 106, 105 region. That would definitely put pressure on equities as rates hit an all-time new high, but it would probably be done on much less volume and much less momentum, being a classic fifth wave. And that would be probably the final move in this move before we get that buyer stepping into bonds again. The other scenario, and you see how overlapping this isn't a clear 5-wave pattern, which is why I put this in here. If it was 5 waves down, 3 up, then we know we're going down for that 5th wave, but we don't have that. It's very overlapping right here. And so what that's telling me is that this could just be the B wave of this larger A wave. So we have A, B, and then C wave up to here. And that would suggest that this was the low for bonds, and that rates have peaked, but they're doing so in this kind of overlapping corrective fashion. Once again, it looks like we're setting up for one more drop down into the 112 region. You can see how this level is holding, but the kind of a descending triangle pattern right here. So I'm looking at 112, and I really want to see 112, 113, 112 hold below there, and it starts building the case that we have one more low to go. So rates basically are just not buying what the Fed and what the inflation data is telling, what the equity market is thinking is going on, if you will.